Well, good afternoon, everyone. Thank you for joining us on our webinar today. We have a fantastic speaker and a timely topic, the 2016 presidential election and the global markets. I'm Nathan Mercereau, president of Planning Alternatives, and I'm just delighted to have Jeff Kleintop, who is the chief global strategist for Charles Schwab. And Jeff is presented on webinar formats with us before, and Jeff, welcome. Really excited to have you here.
Thanks. I'm thrilled to be here. It's a wonderful opportunity.
Jeff is in Boston. I'm here in our main office in Michigan, and we're doing this webinar for clients throughout the country, and we're also recording it. So if you have someone that you would like to pass this information on to, please have them go to our website, planningalt.com, and in another day or two, we'll have the recording up and ready. I would like to mention that if you do have questions during the webinar, feel free to submit those through the question box on your screen, and at the end we'll go through and see if there's any open questions that Jeff can answer and speak to, and that'll be a way to have it be very interactive for you today. Well, I'd like to make a few comments about Jeff's experience. Jeff is well known in the national media, and he speaks at a wide range of events, and in fact in a couple weeks there's a major industry conference that Jeff will be a keynote speaker at. But in the meantime, he's been quoted in the Wall Street Journal, the New York Times, Barron's. He's on television a lot. You'll see him on CNBC, Bloomberg, Fox, ABC, and he's been listed as the Wall Street Journal's one of the best and brightest. And Jeff has great insights, and he's also a published author on the book Market Evolution, How to Profit in Today's Changing Financial Markets. So Jeff, welcome, and this is a timely topic because elections are around the corner. There's a lot going on in the economy, a lot going on in the world, and there's a lot on people's minds. Investors are concerned. So what are some of the issues that you see specific to the election? And I think as we dive into this, maybe you could talk about some of the candidates' views and what are they proposing and what should investors be aware of between the two party candidates.
Sure, Nathan. Well, you know, this campaign, the campaigns, I should say, have not been long on wonkish policy details. They've been far more about character than what we're used to, although I guess a presidential election always kind of comes down to character. So there haven't been a lot of detailed policy proposals to go through to really ferret out the differences. But, you know, high level, what I can tell you is the market tends to, so we'll see, for example, infrastructure stocks tend to move with Clinton's probability of winning, as do some healthcare companies, hospitals, Medicaid HMOs, healthcare technology, companies that make money on volume of healthcare, seeing that Clinton more likely to sustain the Affordable Care Act and those types of things, promoting volumes of healthcare. Renewable energy as well seems to move with Clinton's prospects, and a number of other industries as well, but you kind of get the sense there. It's about infrastructure, about the volume of healthcare and maintaining this broad reach of healthcare availability that was brought under Obama, and then again renewable energy, that constant focus on green. For Trump, we tend to see companies like healthcare companies more focused on pricing, like biotech and pharma, do a little bit better when his prospects improve. Defense tends to move with Trump. I think the expectation is he'd be quite a bit more hawkish than our former Secretary of State in addressing foreign leaders and foreign threats. We also see regional banks and some financials do a bit better with Trump and Clinton, although both seem to be antagonistic towards the financial services industry. And then non-renewable energy, you know, good old coal and oil seem to do better with Trump's prospects. And for-profit education as well under Trump. So those are kind of the differences and subtleties of industries as they shape up as we see these polls shift around. So that's how the markets are seeing the differences in these two candidates. But Nathan, I find that where they are alike is maybe more important for investors than where they're not alike. And the question related to that I'm getting most often is all about all the anti-trade rhetoric, right? So, you know, both candidates have spoken out against the TTIP and the TTP, the Trans-Pacific Partnership. And we certainly had an isolationist campaign from Sanders, and not just in the U.S., but broadly this has been a theme. The Brexit vote in Europe is a vote against integration. We've seen the rise of anti-globalization parties in Europe in recent years, and many people are wondering, is this the end of free trade? And if so, what happens to all those multinational companies that make up my stock portfolio, or the corporate issuers of the bonds in my bond portfolio? And so to reflect on that, I think the risk to multinational corporations posed by all this anti-trade rhetoric of both candidates is not likely to be as worrisome as it might at first appear. First, it's unlikely major changes to trade deals would get through Congress. And it's also, by the way, always part of what presidents campaign on. Obama campaigned against NAFTA. Oh, we've got to make a lot of changes to NAFTA, he said in 2008. We didn't make any changes, and we've got a lot more trade deals coming down the pike from his administration. So, you know, I think it's one of those things you just do as a president. It works well with test audiences, but in reality, you do tend to side with more of a trade-oriented agenda. But more importantly, companies have become much more global in their manufacturing and their sales, and they have a local presence, and that helps mute the impact of any sudden rise in tariffs or non-tariff trade barriers. I'll give you a quick example. Jeff Immelt, I was on a panel with him, I don't know, months ago, and he was talking about how GE used to have one plant that made locomotives. And they'd make them there, big giant, you know, logistically intensive industry, and then they'd ship them wherever they sold them. Now they have 7. They make them where they sell them, and this localization, Nathan, has been interesting. It allows these companies, you know, to kind of get around any of these barriers that might crop up. So I want to downplay a little bit of some of the worries about, oh my gosh, if we put on 35 or 40% trade barriers, and countervailing tariffs are put in place by other countries, what happens? I think that's overstated. I'm not saying there wouldn't be nothing on the trade front. We may not see progress on the trade front as we have in recent years, but that doesn't mean we're going to undo a lot of what we've seen. So, and I'll just finish up by saying the market seems to be pricing in the status quo outcome, which is Democrat in the White House and a very, very closely divided Senate and a House that remains in the hands of the Republicans. And that kind of a gridlock environment doesn't lend itself to sweeping legislative changes. So I understand there's a lot of emotion tied up into this election, but in terms of substantive outcome, may not be as dramatic as many fear.
That's great insight. And if I heard you correctly, you're alluding to a trend on the global level that's developing around countries and companies anchoring their production in local economies, which creates a trend in itself. So it's not directly connected to campaign rhetoric of what happens if one person wins or not. It's actually an emerging trend around the world.
Yeah, exactly.
Yeah, good. Well, I know there's a few points that we had chatted about before around the global market outlook, and would love to hear your insight on what you think is going on globally, and what are you seeing as you do your analysis and your review and presentations throughout the country.
Sure. Well, I have, you know, there are a few thoughts I have on what I think is going to be really shaping the market environment really here for the month of October, but they also extend out over the course of the next year. And I've got one interesting kind of quiet positive for the market that I think very few people are focused on, and that's whether we're about to see a wave of buying. And that's kind of this first chart here. Well, everyone knows, I think, without the benefit of financial advice from firms such as yours, Nathan, individual investors tend to just chase performance. They buy what's been doing well in the past and sell what's been doing not so well. And what's interesting is it tends not to be over a 1 month or 3 month or 1 year time horizon. Investors tend to chase 5-year trailing returns. And what you see on this chart is that blue line there is the 5-year return for the global stock market. This is true, you know, globally. We've had a high correlation across markets, so they all tend to look like this. That's the global stock market. And the other line, the orange line, is the buying and selling by individual investors of global stocks, both U.S. and international equity stocks. So money coming in and money coming out. You can see when the line's going down, you know, they're selling or they're reducing their holdings while returns in the past have been falling. And then as they were rising there, you can see most dramatically in 2013, they were buying them as the 5-year return went up. Well, in the last couple of years, we've seen these lines go down, meaning the 5-year return was fading a little bit, not as strong. And in fact, had suffered, you know, quite a bit here. It really had fallen down, almost down to the flat line. Yeah, exactly. And individual investors have been selling, but we are now at a turning point in the last couple of months because largely we've dropped off some really terrible months back in 2011, just over 5 years ago. August of 2011, I know you remember well, was when we had that debt ceiling debacle in Washington and concerns about U.S. debt, and we did get downgraded by S&P, and that caused a bear market globally. Stocks really pulled back. Well, now out of sight, out of mind. So the 5-year return dropped off that August and September of 2011, and the 5-year return has started to turn back up. And I would not be surprised to start to see that orange line, the buying of individual investors, follow that a bit higher. So for the first time in a couple of years, individual investors might follow corporate investors doing their buybacks and start to buy some stocks here and help limit some of the volatility we may get from some of the other factors I might discuss.
And when corporations do buybacks, Jeff, what is their motivation for doing that? Could you just give a quick explanation of what that is and what's happening during a buyback?
Sure. So, you know, right now, the cost of, there's not, companies are growing very slowly. They don't have a lot of great reason to plow all their cash back into expanding the capacity of their business. You know, sales are relatively sluggish. And so rather than reinvesting in the business, they've been trying to find ways of, you know, using that cash is earning zero, right? So they're plowing it back into the company by buying shares. And that reduces the number of shares out there. So therefore, earnings per share look a little bit better to the tune of 1 or 2% a year as they're doing this. But the idea is to put that to some kind of use, reduce the you know, the business's excessive cash balance and try and do something that returns some value to shareholders. And the consequence of that is that they have been the biggest buyers of equities for the last couple of years, helping to support you know, the modest gains we've seen in the market.
So when the individual investor, if they follow that corporate investor, what is the consequence? This is a slide that you had shared with me earlier. And could you just explain what the second wind is about?
Yeah, so, you know, and these are huge numbers. I don't think we'll see anything quite to this degree, but look, the last time we saw this was in March of 2009 and May of 2012, when individual investors stopped selling after a year or two and started buying again. The returns over the next 6, 12, and 18 months in those two scenarios were fantastic. Look, over 18 months, between 40 and almost 60% returns in the stock market when the big 800-pound gorilla of investing, the individual, comes back. You know, we often think that hedge funds control the market or these computer trading algorithms or it's foreign investors or sovereign wealth funds. The fact is, it's individuals, and everybody else follows them when they move in or out. And so having those individual investors, which, you know, we know here at Schwab, we see people are holding a little bit more cash, individual investors, than they usually do. They have the capacity, particularly if they start to see losses in their bond portfolios as rates move higher, to move into stocks and potentially propel some gains. I'm more focused on it limiting downside volatility than being a huge gain to the market on the upside over the course of the next year or so. But there is that potential there.
What about on the risk side? I know that we're in a slow growth environment. Corporations are looking at what to do with their capital. What do you see happening on the earnings side?
Yeah, this is the biggest risk I'm focused on at the moment. We are about to head in to the earnings reporting season globally. So as companies report their third quarter results, and what's happened is if you see this next chart, there's been a gap that's widened out between what analysts expect earnings to do and what they are actually doing. You can see it right here. Two different scales on this chart because I just wanted to see the trend. But for 2 years now, this only goes back a year, but for 2 years now, earnings expectations have been falling. Analysts have been lowering and lowering and lowering their outlook for earnings. At the same time, earnings have actually been falling, in part because of the energy sector and the material sector and the drop in commodity prices, but just the general drop in overall economic activity. But what you can see starting at the beginning of March is this widening out of this gap that analysts started to get a lot more optimistic about earnings over the last 7 months or so, 8 months, but actual earnings continued to fall. And that gap now between the two is the widest it's been since 2009, as you can see on the next slide. So you can see the orange and blue lines are still the same. There's expected earnings and actual earnings. And then that green line shows the difference between the two. And right now, analysts are forecasting a 24% earnings growth rate over the course of the next 12 months. And Nathan, I just don't know where that's going to come from. We're not coming out of a dramatic global downturn as we were in 2008 and 2009 to power that kind of a gain. We did see that kind of a gain then, or back in the early 2000s where we came out of another major global downturn and profits fell by 50% and came rocketing back again. We just don't have that kind of built-up momentum economically. So I'm afraid there's some risk here that these expectations might be disappointed, and companies may issue guidance in the coming weeks that take down those numbers, that encourage analysts to cut their estimates rather than raise them. And this year it's been interesting, despite all our talk about central banks and politics and you name it, stocks have followed the revision trends in earnings, meaning they fell in January and February as earnings revisions were still coming down, bottomed there, and stocks have been generally drifting higher over the last 6 or 7 months in conjunction with those higher earnings estimates. So I worry if analysts begin to cut them that we could see some volatility return, and the month of October here could live up to its reputation as a scary and more volatile month for investors.
I know there's a lot of concern around the economy, around recession. What are you seeing as you look at some of the data and doing your analysis?
Yeah, this is so it's interesting. So where I'm getting this idea that there's just not enough economic momentum to lift earnings in that way, you can see on this next chart, real simply, this is just world GDP, and it bounces around all over the place. We're going in and out of recessions. What I shaded there isn't a recession. What I shaded were the expectations for 2016 and 2017 from the IMF. Now, the International Monetary Fund is, believe it or not, just about the best forecaster of GDP out there. I mean, they're better at forecasting U.S. economic growth than the Fed is, and they're not perfect by a long shot, but they're better than most. And what you can see here is their expectations are for pretty average growth, maybe even slightly below average growth for this year, 3.1% and 3.4% for next year. Not the kind of booming numbers we saw, as we bounced out of the downturns in the early 2000s, or even in 2010 as we bounced back from the 2008-9 recession that gave us big earnings gains. Just not likely to see that kind of momentum. So again, that feeds into that backdrop of a more sluggish earnings growth environment. Still see growth next year, but much more modest than what analysts are forecasting. And I'm worried in the near term, Nathan, about some air pockets in the economic data. A little bit of a worry that some of the data might come in a little worse than expected. And one of the reasons for that is weather. That's my next slide. Economists are...
I will say, Jeff, I love the way you look at data, and I have seen some of the most interesting combinations of data sets since I've known you. And I'm curious to hear about this one. What are you thinking here?
I'm just passionate about the truth here, and the truth is that economists can't even seem to forecast the darn weather. So what's fascinating is I've got two lines on this chart. One is the Citigroup Economic Surprise Index for the G10. Those are the 10 biggest countries in the world. And this index is a fascinating one. It takes all the economic data they release every day, and if the line's going down, it means the data is missing expectations, worse than economists expected. And if the line's going up, it's better than economists expected. It's surprised them to the upside. And the other line, as you can see, the orange line, is the temperature at JFK Airport. I mean, it's that simple. Economists can't seem to figure out the weather. And so as the temperatures begin to cool down, so does the data relative to expectations. And we are now at that threshold where, you know, we're around the 60-degree mark at JFK and around 0 on the Citigroup Economic Surprise Index. It wouldn't surprise me to start to see the data begin to disappoint. Not that it's outright bad, but that it's worse than they expect, and some of that just related to weather. We are about to get a really, really nasty hurricane come up the East Coast. I wouldn't be, you know, that's part of all of this. That will disrupt flight activity, logistics. It will have an economic impact, no doubt about it. And you know, you just start to see that type of thing through the winter months. So don't be surprised if we see some economic data that's a little worse than expected. Doesn't mean we're falling off a cliff. It's sort of normal, but it could shake up the market that's beginning to expect better data and is beginning to price in the expectations for the Fed to begin to hike rates again in December based on more consistent economic performance. So if we do get some data that comes in weaker than expected, we might see some questions about whether the Fed can hike rates in December as we still expect them to.
Seeing this chart makes me remember the quote I saw years ago that economists predicted the last 10 out of the last 3 recessions. So if we can get any better correlation in our predictability, it would be appreciated. So I love this chart. What do you So what are you seeing on the economic side as it relates to the risk of recession? And I know that's on a lot of investors' minds, and we've had a great run in the recovery from the Great Recession of 08, 09, but it seems like we're muddling along a little bit. But what's your take?
Yeah, it's sort of an unrecession, if you will. You know, we're kind of, growth is below average, but it's not contracting. It's sort of this weird unrecession kind of Alice in Wonderland kind of upside down world where interest rates are negative in some countries, where the unemployment rate is very low, but so is inflation. You know, it's just sort of a very strange environment. But we can draw some comfort that we're not just passing through a weak growth environment headed to recession by using things like the yield curve. I know Nathan used to present this many times. I'm a huge fan of using the yield curve to try and get a sense of where we are and the likelihood of a recession in the next 12 months. So I'll just take us through this. The purple line on this chart is what we call the yield curve. It's very simple. It's just long-term interest rates minus short-term interest rates, just taking the yield on the 10-year government bond minus the 3-month treasury bill. And usually longer-term interest rates are higher than shorter-term interest rates by around 2% or 200 basis points, as you can see on the chart here. You know, sort of look across, that's kind of the average for that purple line. But rarely is it ever average. It's usually above it or below it, and sometimes it gets well below it because the Fed hikes short-term interest rates till they're in line with long-term interest rates, and we get to 0, or even to where they're higher than long-term interest rates. We call that an inversion of the yield curve when that purple line drops below 0 and short-term rates get above long-term rates. Each time that's happened over the last 50 years, I've noted it with one of those orange dots, and those have happened almost exactly 1 year before those big shaded columns, and Nathan, I know you know what those are. Those are recessions. And so what the yield curve has done is they've told us 1 year ahead of time when a recession is coming. Never been wrong, never told us we were going to get one and didn't, unlike the economists you mentioned who forecast 10 of the last 3 recessions. The yield curve gets it right. And what's even better is that blue line up top, which is the stock market. The yield curve tells you right about almost to the month when the stock market's getting to its peak. So it gives you a sense of saying, hey, look, a recession is coming about 12 months from now. Stocks might be peaking out. Time to think about, you know, making sure you have enough cash, thinking about being prepared for what could be a couple of years of a rocky time in the markets and the economy. So it's a wonderful tool. What it's telling us right now is don't worry about it. Right now it's saying, you know, the yield curve is not that far from where it is normally, not suggesting we're going to get a recession in the next 12 months. We do know that purple line's probably headed down towards 0, but at a very, very slow pace, in line with how slowly the Fed is hiking interest rates. Usually they'll you know, tear the Band-Aid off and they'll raise it 3% in a year, and we're seeing more like 0.25% a year. So very slow process. That means we may not get there for some time, but encouragingly, certainly this, the most accurate predictor I know, not pointing to a recession in the next 12 months.
That's great. So what about other parts of the world? What's going on that may precipitate recession or slow growth in different parts of the global economy?
Yeah, well, if we follow through, the same thing we can do across the globe, and rather than show you all the different charts for all the different countries out there, regions, I'll just highlight this. This kind of gives you the probability of a recession based on a historical probability, based on where the yield curve is in these countries today. So it's anywhere from 12, 15% to 30%, somewhere in there. You'll notice none of them are zero. The probability of recession isn't zero anywhere. Frankly, it's never zero. But it's not 50% or higher either. Nowhere is it very likely to see a recession next year. But there's maybe a 1/3 chance. And that's probably about average. And so I'm not overly concerned as I look around the world that we're headed into a global recession or that we're going to see one of these major economies slip into recession as we did last year with Canada or the year before with Japan. We may for the first time go 4, 5, 6 quarters without a major G7 country in recession, and that's better news for economic growth and maybe better news for profits as we look out to the next 12 months or so.
There's a lot going on with central banks in different countries, and we'll hear headlines about what's happening in Brazil, what's happening in the Eurozone, and there seems to be a lot of consternation about how to stimulate various economies. What are you seeing at the central bank level, and how does that link to the Fed too? Because the Fed is the elephant in the room in terms of its influence. How do you kind of coalesce all of this?
Yeah, there are a lot of different things central banks are doing. I'm no fan of negative interest rates that they have in Europe and other European countries, and in the Eurozone and in Japan as well. I think they're looking for ways to try and mitigate the negative consequences of those policies, which are bad for banks, bad for pensions, lots of things. But
and
more
Jeff, could
of
I
a focus.
Ask you to, I'm sorry, could I ask you to define negative interest rates? What's going on? Because we hear that term, and I know some of our listeners may not be as familiar with what that means.
Yeah, well, sure. So in some countries, we know here in the U.S. the Fed had cut interest rates to 0. We used to think that's as low as you could go, but some banks central banks around the world have found a way to cut short-term rates below 0, and actually result in negative interest rates, very short-term interest rates. In fact, they've extended across the curve to where there are some countries, like in Switzerland, where you can get a mortgage with a negative interest rate right now, meaning you buy a house and the bank pays you. Imagine that. That's another, Alice in Wonderland kind of down the rabbit hole kind of environment that we're in. And it's causing distortions. No surprise in Switzerland, they're having a housing bubble reignite because of this. And the flip side of it is you have to pay your bank interest on your checking account. It's a strange world that we're in, and they're trying these aggressive approaches to stimulate global growth. I think they've reached the limits on a number of these things and recognized some of the downside to it. But there's a flip side to it, which is it's very difficult for any one central bank to hike rates in isolation. That's what the Fed has been looking to do. And this chart here is an interesting one because what I do is I look at 76 different central banks around the world and their movements on interest rates. And what you can see here is the net of their changes every month. And for most of what we've seen in the last 2 years or so, you can see they've been cutting, meaning more central banks cut rates, sometimes in the negative territory, versus hiking rates. But back last year, in December of 2015, the Fed hiked rates in the U.S. for the first time since the financial crisis. And ahead of it, during that month, and just after it, many other central banks followed suit. They didn't want to be the only ones hiking rates for fear their currency would be negatively impacted, or a variety of things might occur. So when the Fed goes, they pull a lot of other central banks along with them. And as we move towards what may be a rate hike from the Fed again in December, we might see a lot of the rest of the world's central banks follow along with that and begin to hike rates. In some countries, not a great thing. They need low interest rates, but they'd be forced to follow on with the Fed. The orange line on there is you can see what happened to the stock market. As interest rates are being cut generally globally, stocks did okay. As soon as the world kind of tightened up financial conditions and started raising interest rates, stocks fell into a little bit of a tumble there from August all the way through February of last year until central banks generally move back to cutting again. So I worry again, maybe a little bit of volatility returning to the markets as we move towards this Fed rate hike in December, which we still think is likely, and some central banks both get ahead and follow the Fed along with that, just can create some of this additional volatility in the coming months.
And what size of rate hike would you anticipate at the end of the year and even beyond next year? What's the expectation in the short and long term about interest rates in the U.S.?
Yeah, in the U.S., probably only 1/4 percentage point here in December. That would make 2 1/4 percentage points moves, one last December and then this December. Next year, we could see 2 moves, perhaps, if economic data behaves the way we believe it will. So we could maybe be at a 1% rate on federal funds, the federal funds rate, the policy rate the Fed uses by the end of the year. That might mean slightly higher longer-term rates, the rates we use to buy cars and houses. You know, that could go up maybe another 0.5% or maybe 0.75%, maybe even a full percent over the course of the next year. So not a big upward move in interest rates from these historically low levels. They would still remain quite low, but a little bit higher than where we're seeing them today.
We've talked about the U.S. political scene and how that has a lot of potential muted impact on the economy because of the rhetoric and then the balance of power and all the other trends. There's been some significant shifts, though, globally, specifically in the Brexit story. I know that was a surprise to all of us earlier in the year when Brexit occurred. What do you see happening through the Brexit lens, and specifically as it relates to trade and some of the things you mentioned earlier in our conversation?
Yeah, well, we talked about it a bit. Brexit's an interesting one. We'll have to see where things end up with Brexit. Probably not till the first quarter that official notice is given to the European Union that they wish to leave. That starts 2 years worth of negotiations, which can then be extended. So I imagine it will be a very lengthy and drawn-out negotiation with nothing happening immediately, except maybe some businesses starting to relocate, maybe for financial services employees, for example, out of London, maybe to Dublin, Frankfurt, or Paris. So you might see a little bit of a drain in what's been a very hot London real estate market. A few other things that might negatively impact UK economic growth over the course of the next year. This year, by the way, the UK is growing faster than the US. In fact, growing faster than just about every country in Europe, Japan, the US, Canada, you name it. That may not be true next year. They may slow down a little bit. So we'll have to keep an eye on it, maybe not a recession. But global trade, as I mentioned earlier, and this is a great way to look at it, a lot of fear that globalization's already taken a step back here, that the trade's already receded. This is the value of world trade, and you can see in 08 and 09 really fell back, and then it's really slipped here recently. But that's looking at it based on the value of what's traded. If we look at the volume of what's traded in this blue line, what you'll see is that the volume of trade really is still near all-time highs. So it's just the price of oil, the price of copper, the price of many things that's fallen that kind of gives us a sense that we're in a big trade recession. But in fact, things seem to be moving along pretty well. It's flattened out over the last year or so as we've seen a lot of inventory get cleared out in steel production, for example, working down inventories, lots of things. But we're certainly not seeing any kind of deep recession as it relates to trade. And again, that gets back to my comments earlier. And we may, in fact, be on the cusp of a rebound in trade. 2 lines on this chart here. One is the global leading index of economic indicators put up by the OECD. That is just, as you see at the end, the blue line started to tick up for the last 6 months. The other line is world trade, and world trade tends to follow, tends to lag it by about 3 to 6 months. So if in fact, we start to see that continue to move up, trade could begin to actually rebound here, even just in the next few months. So I think the battering some trade-sensitive stocks have taken and may begin to take as we move closer to the election. may be overdone. They may be good buying opportunities. In fact, if you jump 2 slides ahead, I think there's kind of an interesting setup here as we look at the election table. One of the interesting things about U.S. elections is how close they tend to be, and this can feed the volatility and concerns about trade-sensitive stocks as well. So here are the last 10 elections, and only in 2 of them did the winner lead in the polls, and this is using the Gallup polls, not some, fly-by-night internet thing. Only twice did the winner lead the entire year through. In 8 of the last 10 elections, the loser was ahead at some point during the summer months, and in 5 of them, the loser was ahead in late October. So think about that. I'm not using this to call the election. What I'm saying is races tend to tighten up in October. And if that's the case, as follows the normal pattern, I wouldn't be surprised to see this flip-flop back and forth in the polls between Clinton and Trump, and that could raise some uncertainty. As I mentioned before, the market's pricing in a very status quo outcome with a Clinton win. But if it looks that like Trump could win and have some coattails into the Senate and more sweeping prospects for legislative change, well, the market could get a little concerned about the uncertainty that may stem from that, and that could further add to the volatility here in this historically volatile month of October.
So with all these things in the mixing bowl, Jeff, where do investors invest? What do they do? What's the best strategy to think about right now and also in the longer term?
Sure. So the natural question is, what do we do? I think that I'd like to think along the lines of sectors, and it's always amazing to me when I think about investors. They tend to put countries first. So like, well, how much I have in the U.S., how much I have international or emerging or what have you. And there's so much of a home country bias everywhere I go. Nathan, I travel the world pretty frequently, and it's interesting, when you look at the home bias investors have, it's true everywhere. And it's on this next slide, before I get to where to invest, I just want to give you some context. So this looks at where citizens of different countries invest, how much of their portfolio is invested in their home country stocks. You see, the U.S. is right in the middle there. Right at about 75% of their stocks tend to be U.S. company stocks. And you might think, well, that doesn't seem out of whack to me. I mean, a lot of great world-class companies in the U.S. Makes sense to concentrate. If I'm going to pick a country, I know the U.S. well. I know the politics. May not love them, but I know it, and I feel close to it. I feel more comfortable. 75% doesn't seem strange. Okay, but look, that's the same number for South Africa. It's the same number for Spain. Same number for Greece. Right? So much of our wherever we live, we concentrate there. Maybe the only exception is the Netherlands, where there are only a handful of brewers that make up the industry. And I guess after a few beers, they think, yeah, what the hell? So the fascinating thing is, everyone concentrates in their home country, but that creates distortions that they may not realize. A couple areas we like, one that might be energy over the course of the next year as oil prices firm up, financial sector, and the tech sector. And let me show you what that means globally. So one of the most fascinating charts is this one here. So that dotted line across the bottom is the world stock market over the last 15 or 16 years. Doesn't look like it's done much, because Canada has done so well. The blue line there is the Canadian stock market, and look how amazingly well it's done. But the purple line explains why. The purple line is just 1.3 times the World Energy Stock Index. The Canadian stock market is one levered energy ETF, period. That's all it is. We can spend time looking at the economics or the politics or what the Bank of Canada is doing. None of it matters. All that matters is the oil price. And the funny thing, Nathan, is energy isn't even the biggest sector of Canada's stock market. That's financials. But who do they lend to, right? They lend into the huge natural resource base of that economy. So if you like energy and you think, okay, emerging market demand's picking up and supply is certainly oversupplied right now, but the International Energy Agency is telling us that's going to moderate a little bit in the coming years and maybe continue to pull oil prices modestly higher, and you like energy, well, then you're going to really love Canada. But here's the kicker. If you are a Canadian and you have 75% of your money in the the Canadian stock market, you have been invested basically 75% in one sector, in energy. And while that has been great for 15 years, it has not been great for the last 2, and so important for them to be diversified. So energy is one of the areas that we find attractive. Another one on the next slide, financials. Here, Japan. Japan is the financial sector. That dotted line on the chart is the same one as on the prior chart. I mean, it's a slightly different time period. Here's the last 10 years. Same thing, but Japan has underperformed terribly. For the last 10 years, it's been an awful place to be. So is the financial sector, right? And the two just marry up very closely. Even though the biggest sector in Japan is consumer discretionary, the Japanese stock market tends to track the financials. We actually like the financials over the course of the next year as maybe longer-term rates begin to rise. A lot of the banks will begin to see some profitability in those areas. We think lending might begin to pick up. And if that's true, financials may outperform, and it may drag the Japanese stock market right along with it. And then finally, we like the tech sector as well. Tech's been a winner for a while, and that's one of the reasons why the U.S. stock market has performed so well. The U.S., from a global perspective, is one big tech stock. So again, the dotted line is the world stock market. You'll see not as much deviation here. The U.S. does track pretty well with the world stock market. That's because the world stock market, half of those stocks are U.S. stocks. It should be right on top. The U.S. should be right on top of it. But interestingly, only 20% of U.S. companies are tech companies, and we track much more closely to what the tech sector does, Nathan. Tech is the biggest sector here in the U.S. And so we do like technology, and so the U.S. may again be a strong performer next year. But the key takeaway from these charts is to truly be diversified. From a sector perspective, you've got to be global. Because if you only own any one country, you may only one sector. Heck, even if you own 2 or 3 countries, you may only own 2 or 3 sectors. So understand that if you're heavily invested in the U.S., you're going to move like a tech stock. And that's been great for the last 10 years. But you and I remember the early 2000s, Nathan, how that wasn't such a great place to be and why diversification is so important.
Absolutely, and that's what we preach to our clients every day, and we implement thoroughly in our portfolios. So we have things spread out. It's a risk management move. It's a critical approach to successful investing long term. And in fact, we have provided what we call the Presidential Investor Checklist in our latest Quarterly Thrive Report. So if you're a listener today, look for that in your Quarterly Thrive Report. And if you are not a client, feel welcome to contact us, and we will get you a copy of that. And it's simply things to look at as we enter election time, but also keeping perspective on the long-term disciplines that are critical to successful investing. Well, Jeff, thank you so much. I want to open it up for a couple of questions. So if you have a question that you would like Jeff to answer, please submit that on your question box on your computer screen, and we can chat about that. One of the questions is about the relatedness of the U.S. to the global economy. I guess it's more of a chicken or the chicken and the egg question. So is it the U.S. that drives the global economy, or is the global economy driving the U.S.? How would you set the context for the relationship between those two views?
You know, it's interesting. So from a developed world standpoint, the U.S. has a bigger impact on the rest of the world than the other way around. We drive so many, we're just a huge consumer of the world's products and services, just a huge importer, and so we do have a big impact on the developed world, but not as much the other way around. We're still relatively insulated, driven by consumer spending within the U.S., and that really helps us sustain ourselves even through tougher times in, say, Japan or in Europe. You know, I'd note that over the last several years, many of the world's major economies have gone through recessions, and we did not, and that's because we're a little bit more insulated from all of that. But we are becoming more impacted by what happens in the emerging world, where increasingly most of the world's consumers are coming from. Already 80% of the world's population is in the emerging markets, but because of their rapidly rising wealth, they're becoming the biggest consumers. In fact, in 2010, the U.S. was the largest country, if you take a look at middle-class spending, about 21% of the world's middle-class spending came from the U.S. By 2020, we get beaten out by China. China becomes the destination of the biggest country in terms of middle-class spending. And by 2030, it's India and China that make up 40% of the world's middle-class spending, and the U.S. only makes up 7%. So companies increasingly are going to be focusing, manufacturing, and tailoring their products to an emerging marketplace rather than those of the U.S. and becoming much more dependent on emerging market demand than they are on U.S. demand. And that's a fascinating and broad trend that will be shaping us. But for the time being, we are still a bit more insulated from the rest of the world. So we tend to have more influence on what's going on in the developed world than they do on us.
Final question, and we're going to wrap up for sake of time. Is there a chance that we in the U.S. will experience negative interest rates? What's your view on that?
Highly unlikely, but you can't rule it out completely. You know, the Fed, the current Fed, has said that just seems like something that we wouldn't do for a variety of reasons related to, again, pensions here in the U.S. and lending and those types of things. I think we've identified it as more negatives than positives. But you know, we're in an environment where things are a little strange, and the Fed may not have raised rates a lot before we fall into the next recession, and if so, they might need to cut rates in a negative territory if inflation remains very weak. So I wouldn't rule it out completely, but it seems fairly unlikely. Inflation, by the way, has bounced back a bit in the U.S. We've been looking for some inflation. A little inflation is not such a bad thing, and we have started to see that begin to rebound in the U.S. And if that remains on track, we're looking at core inflation right now in the U.S. It's around 2.3%. That's a good number, and that means if it stays around that level, very unlikely to see negative rates anytime soon.
Well, Jeff, thank you so much for your time today. Your insight has been invaluable. You're always such a great communicator of complex ideas, but to make them presentable in a way that's understandable. So thank you so much for your time today.
My pleasure. Always love taking part with you, Nathan, and Planning Alternatives being just one of the great firms around the country that I'm able to spend some time with. So really, very rewarding experience for me as well.
Well, I want to thank everyone who attended today, and you will be receiving a survey. Please give us your feedback about what you appreciated about today, or any helpful suggestions for future topics and things that we can really focus on to bring valuable education to you. And until next time, enjoy your day, and we will see you soon.